In this video, we're going to talk about accrual accounting versus cash accounting. And we're going to do examples of each one so you can see side by side what's going on. We'll start with cash accounting. Cash accounting is the most intuitive and very simple way of doing it. A lot of private businesses use cash accounting to account for things. We use accrual accounting, but I'm going to show you the contrast between the two so that you can understand what the big difference is and why we use accrual accounting and the benefits, especially if you're monitoring a company. So cash accounting, anytime you get cash, it's going to be called revenue. Anytime you give cash, it's going to be called an expense. Heisenberg transactions with Tuco Salamanca. We're going to go through about 4 months worth of transactions and how we would account for it and what we call it if we did cash basis. Keep in mind, this is cash basis. This isn't how we're going to do it in this class, but it's good to see the contrast between the two. So you sell and deliver your inventory, your meth or whatever, costing $500 to a manufacturer, Tuco, who pays you $4,000 for it. So it takes you $500 to manufacture it and Tuco pays you $4,000. So how would you account for that? Well, you'd have revenue of $4,000 because that's the cash that you got. You have expenses. You paid $500 to manufacture the drug. The profit that you'd recognize in that period was $3,500, and the change in cash is $3,500. You made $3,500, and your total cash is $3,500. All right, great. Let's go to the next month. Month 2, you sell and deliver inventory costing $1,000 to manufacture Tuco. So it cost you $1,000 to make this new batch. Because of the size of the inventory that Tuco is willing to buy, you decide Tuco can pay you $8,000. Now, we're not going to get into Tuco and his ability to pay and things like that. We're going to just assume that Tuco is an upstanding, good citizen that is always going to pay us, all right? So we spend $1,000 to manufacture the drug, and Tuco is going to pay us $8,000 next month. So how do we account for that? Well, we don't have any revenue. We wouldn't count any revenue on the cash basis because we didn't get any cash. But we would count the expense. We have an outflow of $1,000 and we don't have any revenue coming in. So the profit is negative. It's a deficit of $1,000. The change in cash, down $1,000. And your cash total is now $2,500. That's the running balance. So you had $3,500 from the month before. It goes down to $2,500 there. Month 3. Tuco pays you the $8,000 from last month in month 3. So this is month 3. So Tuco pays you $8,000 from last month in month 3. So that's this month. Also, Tuco likes your product so much, he puts a cash advance down and pays you $4,000 for an order that you will deliver the following month. So how much cash are you getting? You're $8,000 that he owed you from last month, and he's paying you for next month. All right. So you're getting 2 sources. The total of $8,000 and $4,000 is $12,000. So you're getting $12,000 in cash. You take his cash, but you don't deliver any product in month 3 because he's paying you for month 2 and he's putting an advance on month 4. So let's look at month 3. Well, month 3 has $12,000. That is the total revenue. And you don't have any expenses because you already made the inventory in the prior period. So it looks like your profit is $12,000 and you don't have any costs associated with it. It looks like those electrical vehicle credits that Tesla had, right? You have $12,000 in revenue and there's nothing there. It's just straight cream. It goes down to the bottom line, profit. What's your change in cash? Well, you have an increase in $12,000. And then your total cash goes up to, $14,500 based on the prior balance of $2,500. So month 4, you give Tuco his inventory from the partial cash advance in month 3, and it costs you $1,000. So you give him, he gave you a cash advance. And so you're delivering the product now, and it's $1,000 to manufacture. That's how much it costs to manufacture. So it costs you $1,000 to manufacture, and he gives you an additional $4,000 for the inventory delivered in month 4. So how much is he giving you total for the month 4 inventory? Well, he paid you $4,000 last month, and he's going to give you $4,000 now. So it's $8,000 in total, but all you got was $4,000 this month. So that's all you're going to report as cash is $4,000 for your revenue. That's all you got, $4,000. So that's your revenue. But your expenses, because you made the inventory, are $1,000, and your profit is $3,000 is the net difference. The change in cash is $3,000, and the total cash is $17,500. This, you'll notice, is not following what we call the matching principle. So revenues are appearing in different periods than expenses. It's appearing when the cash is there, and so that's a problem. It's a problem in a lot of ways. Look at Heisenberg's profit for each month. His profit looks all over the place. Does this look like a business that sells something super addictive? No, it's really odd. Moreover, let's say Heisenberg worked for you, all right? So he was your employee. In month 2, what does it look like if you just have the profits to look at? What does it look like he did? It looks like he wasted a bunch of time and energy. But the reality is that he was making a deal. He got an accounts receivable. And what about month 3? Month 3 looks like the most productive month of them all. We're like, hey, let's have more month 3s. Heisenberg, let's do this a bit more, right? But the problem is that he didn't do anything in month 3. He just sat down and did nothing. And if that's your employee and he's doing nothing, holy cow, this is a very deceptive financial report. This doesn't actually track what's actually happening. In month 3, all he did was show up and collect some money for the prior period and the next period. He didn't do his job. He didn't cook anything that year. He's got to go out and cook. He's got to cook and make the stuff that people want to get. So month 2 and month 4, and month 3, they're all over the place because of this cash accounting. And so that's a problem for us. That's not what we do. We don't do that. In accrual accounting, we care about promises. In cash accounting, we only cared about cash. In accrual accounting, we care about commitments and promises and contractual obligations that will happen. And so in accrual accounting, what we're going to get to is more a measure of the economics of what's happening, as opposed to this measure, which is all over the place. This isn't a measure of economics. This is just a measure of what's going on with cash. So let me tell you this classic accounting joke. 2 guys, they're in a bank and it's getting robbed. They're like, everybody get against the wall. And so they go empty the tills and then they start putting a bag out for everybody to put their phones and wallets and everything in there. And these 2 buddies, one is an accountant, the other guy didn't take accounting. So right before the guy that's robbing everybody and take everybody's money and wallets, right before he gets to him, the accountant reaches in his pocket, pulls out a $50 bill and shoves it in his friend's pocket. His friend's like, dude, what are you doing? What is that? He goes, oh, that's the $50 I owe you. If you understand that joke, then you understand accrual accounting. The friend is paying back his friend $50 right before he gets robbed so that he can balance the account and show that he's paid him back because he has this accrual that he needs to pay off. All right. So that's the nature of accrual accounting. Accrual accounting is essentially accounting for the economics of these promises that are owed. So when it comes to these principles, there's a couple of one that we follow. One of them is not listed here, the matching principle, the principle that we match revenues to expenses, right? So that's an important one. So we want revenues and expenses happening in the same period in which they incur. So you might create the inventory in a prior period, but that expense should only show up on your income statement when you get the revenue for it. There's another one, conservatism. If there's uncertainty about a loss, tend toward writing the loss down. If there's uncertainty towards a gain, tend towards not recording the gain. And this idea of conservatism is this idea and principle that we want financial statements to overestimate potential problems and underestimate, the rosy picture that sometimes, some managers might have. So accrual basis, let's go through the same example, accrual basis. You sell and deliver inventory costing $500 to manufacturer Tuco, who pays you $4,000. The revenue is $4,000. What's the expenses? The $500 it cost you to manufacture it. What's the profit? $3,500. What's the change in cash? $3,500. And then the cash total, $3,500. You'll notice this matched the cash amount because there wasn't any accruals really going on. In month 2, we got something different. You sell and deliver inventory costing $1,000 to manufacturer Tuco. Because of the size of the inventory Tuco's willing to buy, he decides to pay you. You decide that Tuco can pay you $8,000 next month. Well, what are you going to have as revenue in that month? Oh, you're going to have $8,000. Remember, last time we had 0 because we didn't have any cash. But what we're going to do now is we're going to have accounts receivable. And the account receivable is for the amount we're owed. And we're going to track that. And we're going to count that as revenue because if he doesn't pay us, if somebody doesn't pay us, we can take him to court and we can figure out ways to settle this and get it. So we think it's probable that we're going to collect from him. So we're going to report that revenue in month 2. So no longer is there 0 revenue in month 2. There's $8,000. And we're also going to report the expense because we actually made the inventory and we sold it in that period. We have a profit of $7,000 for that period. So revenues minus expenses. Change in cash is still $1,000. Our change in cash is still the same, and the total cash is still the same. So our cash doesn't change. We are just accounting for the economics differently. All right, so Tuco pays you the $8,000 from last month in month 3. Also, Tuco likes your product so much that he puts a cash advance of $4,000 for an order that you will deliver in the following month. You take his cash advance, but don't deliver any product in month 3, all right? So he pays you a bunch of money in month 3, but you don't make any product and you don't sell any product. So how much revenue do you have? 0. What's your expense? 0, right? We had a much higher revenue under the cash method, but the accrual method shows what is actually going on. Heisenberg ain't doing nothing. He's sitting on his thumbs, right? Profit is 0. Nothing happened in month 3 except for collecting some money, which is good. And that'll get reflected in our cash account. Net change in cash is $12,000 and our cash goes up to $14,500. So it will be reflected there. But as far as cooking and selling, he's not doing anything. It's not showing up. You give Tuco his inventory from the partial cash advance in month 3, and it costs you $1,000 to manufacture, just like last time. And he gives you an additional $4,000 for the inventory delivered. Well, guess what? We're going to report all $8,000. He gave us a cash advance from month 3 that we had. So he paid us in month 3 $4,000 as a cash advance, and then we also collected $4,000 this month from delivering it. So we have a total of $8,000 that we've gotten for the inventory this month. The $8,000 gets reported as revenue. We have $1,000 in the expenses that's mentioned in month 4. The net profit is $7,000. The change in cash is $3,000 because we collected $4,000 last month. We only got $4,000 this month. So the change in cash for this month is still only $3,000. You don't make up cash. Cash is a real thing that you got to track, right? So some of you might have been tempted to put 7,000 in that next one, but it's really 3,000. 3,000 is the cash. Just like in the prior month, we got $12,000 extra cash, right? So we track the cash as cash, right? That makes sense. So the change in cash is $3,000 and our cash account total goes up $17,500. The nice thing about this is what each month tell you about the business and with each method. Well, the accounting under the cash method, if you're a cash strapped business, cash accounting is really important because it tells you, it tracks the most important resources in the lifeblood of your business, right? If you do accrual accounting, it's really great because it tracks the operations. It tracks your efficiency. Here, we see that month 2 and month 4 are some of the most productive months that we have. And month 3, nothing happened. That enables us to look at month 3 and say, what the heck happened? Heisenberg, get off your butt, get to work. Make something happen. Come on. Which is a better picture of the economics of the business, right? Which is the better picture of what's going on with the actions? It's pretty clear. Accrual accounting is the better picture of what the economics are of the business. We can organize this a couple different ways. We could write long paragraphs like I did above. We could draw pictures, but we're not going to do that. That's stupid. Oh, we use journal entries. So we're going to talk about journal entries in the next few videos. That's how we track the bookkeeping for this, the journal entries. And it's so tasty. It's just really neat. So I'm excited to talk to you about it.